There's a lot of noise when it comes to money and investing. Headlines, market predictions, stock tips, and social media experts telling you what to do. But real wealth is almost never built that way. Real wealth is built quietly, systematically, and over time. And the truth is, most people were never taught how investing actually works. Most people think investing is about picking stocks. It's not. It's about building a framework that allows wealth to compound over decades. And that's what this podcast is about. I'm Denise El Chaar, and this is Private Wealth, the Edit. Hi, everyone, and welcome to the first episode of Private Wealth, the Edit. Let me introduce myself, explain the goal of the podcast, and then dive into the topic for this first episode. I'm Denise El Chaar, and I've spent nearly 3 decades inside institutional investing and private wealth management. I've managed portfolios and investment strategies for large institutions, family offices, and high net worth investors. And over the course of my career, I've helped oversee more than $200 billion in assets across firms like Apple, the United Nations, First Republic, and JP Morgan. And one thing became very clear to me over time. The way sophisticated investors think about their investments is completely different than the way most individuals do. Professional investors do not build wealth by reacting to headlines. They build systems. They think in probabilities. They focus on structure. They talk about risk. They know their time horizon, and they are disciplined. This podcast is about bringing that framework to you. This is institutional investing, one private conversation at a time. To give you the tools to think more strategically about building wealth and not just what stock to buy. Let me be very clear. And this is a disclaimer of sorts. This is a disclaimer. This is an educational podcast about how to invest like the wealthy and sophisticated investors do. This podcast is for informational purposes only and does not constitute investment advice. I'm not here to tell you what stock to buy. I'm here to help you build a portfolio and build wealth. All investing involves risks, and you should consult with your own financial advisor before making any final decisions. The genesis of this podcast. One of the reasons this podcast exists actually started with the conversation between myself and my best friend, Kimberly, my OG friend, Kimberly. So Kimberly is an incredibly successful artist, entrepreneur, and really a creative force in Los Angeles. She built a beautiful life and has a very successful business. And she is really smart as hell. One day she asked me, can you look at this email from X bank? They want me to buy this investment. The name of the bank is really irrelevant because honestly, they all do the same thing. They all have the same products and they all function in the same way. In this case, it was a structured product, which for me was a huge red flag. I'll explain why in another episode, but what I'll say now is this, is that a structured product typically isn't appropriate for most investors. It depends. So my first thought was, how does this fit into the rest of her portfolio? So I said to her, can you show me everything so I can take a look at it? And I opened up the portfolio expecting to see some version of a strategy or a system. And what I found instead was really randomness. It was very, very unintentional. There were trades, there were stocks, there were different accounts. There was a little bit of this, there was a little bit of that. And there were things that made money. And then there were things that hadn't made money. Some actually had been previously managed by professional asset managers in the past. And in staying with that art theme, because my friend Kimberly is this amazing artist, is that portfolio reminded me of a late stage Picasso portrait where it's supposed to be a woman. It kind of looks like a woman, but stuff isn't quite in the right place. And I hope you know what I'm thinking of, but you could see the face. The eyes were maybe in the right place. The nose was somewhat nearby. The structure was attempting to exist, but nothing really aligned. It was a bit of a Frankenstein kind of portfolio. And I realized something important in that moment, and that is that intelligent, successful, and very smart people may have no idea how to invest because they were never taught. That was a light bulb moment for me. It's not because they're irresponsible, and it's not because they're not smart, but it's because nobody ever taught them how to think about investing structurally and not transactionally. And this is so, so common. And when I first meet people and we get around to talking about, oh, what do you do for a living? And I say I'm in private wealth management. And normally the conversation will drift into something about stocks and do you think I should buy NVIDIA or something? So, my goal is to move the focus from the transactional, the stock, that NVIDIA suggestion, to the structural, to the asset allocation. My work will be done when someone asks me, "What do you think my asset allocations should be?" So, that's what I hope to do with this podcast, to give you the building blocks to think structurally and to approach your wealth, meaning your investment portfolio as a system that works together, a structure that connects your goals, your risk, and your time horizon into a portfolio that can actually grow and withstand change and volatility. It should be a portfolio that will work for you over time without you doing a ton of work. Each week, we're going to edit out the noise and focus on the building blocks that actually matter. Not the gambling, not the meme stocks, not the financial theater, but the fundamental ideas that professional money managers use to build and preserve wealth over time. There is a core framework, and over the next several episodes, I'm going to build an investing framework with you, and we're going to start with the concepts that matter most. And the one thing that matters the most, as I've mentioned, is asset allocation. What that means is how much should you actually have in stocks versus bonds versus other things? Because asset allocation is the foundation of nearly every institutional portfolio. It's the thing that most people have never heard of, and it is the most important. It is the secret sauce. And figuring out your asset allocation is a discovery process and that needs some inputs. The first question is, what are you trying to achieve? What's the point of the portfolio? Is this retirement? Is it generational? And then what level of risk are you willing to accept along the way? So, risk, I think about it best in these terms. Imagine you log on to your investment accounts or your brokerage account and you see that you are down 10, 20, 30%. Can you handle it? Can you handle being down 30% for a year? And then this is an extreme example, but it'll help us determine your risk tolerance. Time is also an enormous fundamental element too. And your time horizon has a lot to do with your risk tolerance. Because if you're down 30%, but you have 20 years left to retirement, you probably won't care. But if you're 75, that may not be the case. Another element is how should money be allocated across different types of assets to support that objective? All those decisions are made after specific conversations, and we will go through that topic and suss out the important elements. But this is a fundamental shift because instead of thinking in terms of individual opportunities and what stock you're thinking in terms of, you should be thinking in terms of a system designed to balance growth and stability, a system designed to perform across different market environments, a system designed to compound over time. And once you begin to think this way, investing becomes less reactive and much, much more intentional. So let's jump into a couple concepts. First, I want to talk about time horizon and compounding. We're going to talk about this more, but this is just an introduction. We'll talk about why time is the most powerful force in investing, why someone who starts investing at 25 can end up dramatically wealthier than someone who starts at 45, even if they invest less money overall. Time in investing is like sunscreen, or for those that hate sunscreen, for wearing a hat in the sun. The earlier you start, the better. Compounding, because of time, is one of the closest things in finance has to magic. But most people start investing too late, or not early enough, I should say. If you haven't started and you're not 20, don't be discouraged. There's no time like the present, and we will get into that. Risk is another huge element. We'll talk honestly about risk, not theoretical risk, but real risk, and what it looks like and how to measure it. It's not such an esoteric idea, but we need to think about it. How do you feel when you see your portfolio down? How much volatility can you emotionally tolerate? And how that shapes your portfolio are all really important elements. But again, this all feeds into your optimal asset allocation. I'll introduce a framework professionals use to think about allocation. It's really a simple rule of thumb to determine how much of your portfolio should be invested in equities versus bonds or something else. So there's a rule of thumb that's been around forever, and it's 100 minus your age rule. If you take 100 and you subtract your age, this is the amount of wealth that your portfolio should be in equities, and the remaining should be in bonds and alternatives. The basic concept gained really widespread traction alongside the modern portfolio theory in the mid 20th century. The founder of Vanguard he really famously advocated for this simple age based formula because it's easy. And while the formula was widely taught for decades, many modern financial advisors consider it outdated, to be honest, right now. Why? Because people are living longer. Some professionals really have shifted the rule of thumb to 120 minus your age for equities. But consider this a starting point for your asset allocation. It's a starting of the framework for thinking about how much exposure you may want in equities versus more stable assets. We also want to spend some time in retirement and wealth benchmarking. I have built a model for evaluating whether you're actually on track financially or not. Given your age and your annual income, do you currently have enough in your retirement account to maintain your same purchasing power in retirement? This is powerful. This is compounding. This is math. How much should you realistically have saved at the different stages of your life to be comfortable in retirement? And that's a big, big, big conversation. But here we are, and I will be here giving you those building blocks. And then finally, in every episode, I'm going to talk about what's happening in markets and why it matters to you. Because markets are always reacting to something: inflation, politics, wars, technology. But reacting emotionally to these headlines is not an investment strategy. A well built portfolio is designed to absorb uncertainty, not panic every time the world changes. And we've had a lot of changes lately, so there's a lot of panic to be had. And out of chaos really comes opportunity, and none more so than with investments. In the market segment, I'll break down something happening in the headlines for you and relate it back to your investments. So maybe this is something you hear in passing, but I'll give you some point of reference so you know if it matters or not. At the bare minimum, it'll give you some references or some talking points for the dinner party. So why does this all matter? One of the biggest misconceptions in investing is that success comes from finding the right investment, the right stock, the right trade, the next big thing. But in reality, the biggest determinant of long-term outcome really is usually not what you buy. It's how your portfolio is structured. Like I said, if you ask me, what stock should I buy? That's gambling. That's speculation. But if you ask me, how much money should be allocated based off my age goals and risk tolerance? So that's cool. That's really building wealth. And that's what we're here to do. One of the reasons I wanted to create this podcast is because I realized how few people are really taught these concepts early enough. Remember that I told you time is such a critical element, yet we aren't taught about it until I don't know when, if ever. We teach our kids algebra, we teach them history, but we rarely teach them how compounding works. So my oldest daughter graduated from NYU a year ago, and she's had a Roth for a couple years now and a brokerage account. And so does my middle daughter, who's a junior in college. The amounts are small. I'm not saying they've got a ton saved, but time matters more than size in the beginning. And that's the part a lot of people miss. Again, don't be concerned if you're not 20 and don't have it. We'll get there. In closing, if there's one thing I want you to take away from today, it's this. Building wealth is not about the right stock. It's about building a disciplined environment that can survive the future. A good portfolio shouldn't look like a Picasso painting. It should have structure, purpose, and balance. Every piece plays a role. Over the next several episodes, we're going to build that framework together. Next week, we'll talk about how wealthy families actually build a portfolio and jump into asset allocation, what it is, why it matters, and what yours should maybe look like. Thank you for listening today. If you found this useful, follow the show or share it with someone who you think might find it interesting. Send it to your kids. If you have any questions that you'd like to ask or topics you'd like me to cover, please email me at privatewealthedit@gmail.com. And remember, I'm here to give you an institutional edge, one private conversation at a time.